This was not a routine market correction. This was a shock. In just 24 hours, gold fell around 12%, erasing over $4.1 trillion in market value. Silver collapsed almost 32%, wiping out over $1.5 trillion and officially entering a bear market. The scale was staggering. The speed was worse. At one point, gold lost over $3 trillion in just 55 minutes. Then, within the next 4 hours, it recovered $2.3 trillion. This kind of volatility is rare. It has not been seen since 2008. Put this in perspective. The last time gold fell with comparable force was on April 15, 2013. That day, gold plunged 9%, the biggest one-day fall in 30 years. Silver crashed alongside it, dropping 11%. Today was worse. Silver plunged 32% in 24 hours, approaching dislocation seen only during major liquidity crises. From all-time highs of nearly $5,600 an ounce, gold is now trading around $4,700, while silver is trading below $78 after touching a peak of $120 an ounce. This was not just gold and silver. The sell-off spread across the metals market. Copper fell 10.3%, palladium collapsed 20%, platinum plunged 23%. This was not isolated. This was system-wide. The shockwave spread, the fallout spilled into digital assets. As cross-asset correlations snapped higher, automated liquidations took over. More than $1.68 billion in crypto positions were wiped out in 24 hours, the largest liquidation event of 2026. US markets turned red, Asian markets followed. This was global. Why did this happen? To understand the crash, look at what came before it. In 2025, gold surged 65%, silver exploded 150%. Even after the crash, gold is still up around 18% in January, nearing its strongest monthly gains since 1908. Silver remains up around 40% this year. Investor demand into precious metals had reacted extreme levels. In January, it accelerated further as investors rushed into safe havens amid fears of dollar debasement, concerns over US Federal Reserve independence, trade wars, and geopolitical tensions. The crash was triggered by a sharp rebound in the US dollar after US President Donald Trump struck deal to avoid government shutdown. That rebound also followed reports now confirm that the Trump administration was preparing to nominate Kevin Warsh as the next Federal Reserve chair. Experts believe the Warsh pick should help stabilize the dollar some and reduce asymmetric risk of deep extended dollar weakness by challenging debasement trades, which is only why gold and silver are sharply lower. But how the collapse unfolded, since the global central banks haven't stopped their buying spree. Just hours before the crash, gold had touched nearly $5,600 an ounce. Silver peaked above $120, both all-time highs reached on January 29. After 7 straight sessions of gains, the market was stressed and investors booked profit. Another factor made it worse: leverage. Future markets were crowded with traders using high leverage positions. So when prices dipped slightly, margin calls were triggered. Forced selling followed, prices fell further. More margin calls kicked in. A chain reaction. The bottom line, this was not a vote against gold or silver. This was a leveraged market breaking under pressure. When leverage unwinds, markets do not correct gradually, they crash.